Well, what a disappointment. The long-awaited Bank of Japan Policy Board meeting set a 2% inflation target, as expected, replacing the current vague 1% goal. But although a target sounds more concrete than a goal, they really didn't say how they were going to achieve this. They did say they would buy 13 trillion yen a month in government bonds in a Fed-style open-ended quantitative easing program, up from 10 trillion yen a month currently. But the program doesn't start until next January 2014, when the current program is set to end. So there's no immediate change in what they're doing, despite all the media hype that this is the beginning of a new era for Japan. The main effect may just be to help the LDP win the upper house election in a few months by promising to boost employment and construction in rural areas. Politics may be as much of a goal here as any macroeconomic policy aim. That would explain why there's a lot more talk than action at this point. The Bank of Japan may also be hoping that, like the ECB, they can achieve their goals merely by promising to buy bonds in large quantities in the future. Perhaps that explains why they decided to wait a year before implementing the new program. I'm still long-term bullish on dollar yen and euro yen, but I think the market has to absorb this shock first. I'd expect the retracement to continue, and I see both dollar yen and euro yen headed lower to maybe 88 the figure and 117 the figure respectively, before jawboning by Japanese officials starts the easing cycle all over again. In any event, stale dollar yen bulls may eventually be rescued by China, which is ramping up the tension between the two countries over those disputed islands. That may cause actual damage to Japanese exports to China, as well as a more nebulous hit to confidence in the country generally. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.